who are people of color or low income and Native New Orleanians, with the goal of being a resource for our small and startup businesses to help them get bigger, as well as our culture bearers to maintain the cultural resilience of our city. So as we are entering into this strange time and getting used to it and actually starting to think about reopening, Fund 17 has been planning webinars around topics relevant to adapting to COVID-19. So if you were unaware, you can go to fund17.eventbrite.com and you'll see some upcoming webinars, our support group that we're launching towards the end of the month, and another adaptive coaching series called Pivot. So I would encourage you to join that. So thank you everyone for coming today. We have, before we get into the main topic of the day, which is cash flow analysis, something that we need to be revisiting more frequently right now with the unpredictability of the market, or even the new predictability of the market. So we also have our co-host SCORE on the call. Jay from SCORE, their national technical assistance provider. I'll let him say a little bit about their work.
Thanks, Antonio. Yes, I'm Jay Reed. I'm the local chapter chair of SCORE Mentoring, a national nonprofit that assists in business development. We like to take a supportive role with the rest to help the rest of the business development community. Just because we understand that working together will accomplish a lot more than if we try to take everything on by ourselves. I didn't want to say too much, but we are here to help. We do workshops just as everybody else does, and we like to partner with organizations like Fund 17 on different projects like this one. If you need any assistance from us, because we do have a virtual library of resources like templates and business guides, you can visit our website at neworleans.score.org. You can also request a mentor. But that's all I have for today, Antonio. Antonio, you're muted.
I was just saying, thank you so much for partnering with us. It helps us to provide programs, but also to reach more people. So thank you for helping to get the word out. Great. So with that, I will briefly introduce and then turn it over to Drew Schneider. Drew is going to be leading our webinar today. I've known Drew for probably more than a year, and he's been volunteering with us and mentoring different entrepreneurs on their financial questions. So with that said, I will let him say a bit more about himself and go into the presentation.
Well, thank you, Antonio, and obviously thanks everybody for joining. Thank you, SCORE. Just to go over the presentation, so Teresa last week did a really great presentation on sort of an in-depth analysis of how cash flow projections go. So we're going to touch on that a little bit, and then we're going to talk about some other parts as well, including using cash flow projections and other financial projections in order to make better decisions on your business. And then a little before that, I want to talk about some of the, I guess, intermediate steps before you get to cash flow projections. So setting up bank accounts, creating a bookkeeping system, and then ultimately gathering the data in order to start predicting some of your future cash flows. A little bit about myself. So my name is Drew Schneider. Originally from New York, but I've been in New Orleans now, including college, for 9 years. I used to be a teacher, and currently right now, I work at a company called Blue Vine that does loans for small and medium-sized businesses. So in my role as a senior underwriter, I analyze potential business applications. So I'm looking at things like financials, projections, different debt on different companies, and then deciding whether or not we can issue different loans. Just so in this role, I've seen a lot of different small businesses, and I've become really passionate about helping small businesses succeed, especially in today's world with COVID-19 and everything that's been going on. So let's go through the next slide, the agenda slide, just to go over again exactly what we're going to talk about. So we're going to start first with talking about the importance of separating and tracking business finances from personal finances. So I know a lot of people, when they start out companies, especially if it's just sort of a side project as you're sort of building it up, a lot of people essentially commingle their personal finances with their business finances. So on the next slide, we're going to talk a little bit about why it's important to actually create a separate business entity as well as separate business financials. Then after that, we're going to actually go into how you go about separating and tracking business financials from your personal financials. One of the reasons being that it's going to help us have an idea of what's gone on in the past so that we can start predicting future cash flows. Obviously, cash flow projections are important, especially now with a lot of the stuff that's going on with the coronavirus pandemic. Then in the third point, we're going to go through actually creating cash flow projections. So I'm going to spend a little bit of time on this. I know last week, Teresa Kenny from Office Ops did a wonderful, superb job, in-depth presentation on creating cash flow projections. So I'm just going to review some of the top line points that she talked about last week. She also talked a little bit about using cash flow projections to make better decisions. So I'm going to build on that a little bit, and then especially in times like now, talk about the importance of cash flow projections and how you could use this to make better decisions. So whether it's a restaurant that's deciding whether or not they want to do takeout in order to get some revenue during this time, or whether there's some other different business segments or options that different business owners are considering. Then the last two, we're just going to end with questions. I'll give you a link to my contact information. So as Antonio mentioned on the side, I give free volunteering mentor services to small business owners, particularly in the areas of accounting and finance. So I'll leave my email address at the end in case anybody has any questions or essentially wants to have a phone call to go over anything that may be going on with your business. And then finally, we're going to finish the links and resources that I'm going to be talking about during this presentation. I'm going to have a final PowerPoint slide that just has a list to these different links that you can potentially access. So let me go to the next slide. I apologize in advance just because I'm going to be looking at some of these notes down here. So you're going to only have a view of this right now. So first thing I want to talk about is why it's actually important to separate your business finances from your personal finances. So the first point is that in general, as pretty much any endeavor in life, the only way you can get better is if you have an accurate scorecard of what's actually going on. So business is the same idea, where if you're actually able to separate and track your business finances, then you have a much more full picture of what's going on with your business and what some of your strengths and weaknesses are, and what are some potential issues that you may be facing in the future. So we're going to be talking in this presentation a little bit later about how to use an accurate scorecard to make a better decision in the future, including creating cash flow projections. And then I will say that a lot of businesses use past performance in order to sort of predict or get a sense of what's going to be going on in the future. It is a great tool, but I will say that's not a perfect tool, right? It's not necessarily the case that past performance automatically guarantees what's going to happen in the future. Obviously, 2 or 3 months ago, nobody could have known what was going to be going on with a lot of the quarantine and coronavirus issues that are going on. So along the ideas of creating an accurate scorecard of your business, I sort of liken it. I know a lot of people have been watching The Last Dance, the Michael Jordan documentary recently. So if you have a scorecard, if you actually have statistics that show you what you're good at and what you're not good at, it lets you improve upon those strengths and weaknesses. So an example is, let's say, a basketball player like Shaquille O'Neal, who is not known for being a good three-point shooter. If he didn't have the statistics to back up that he wasn't a good three-point shooter, he could have hypothetically took way too many three-point shots and ultimately hurt his team. So this idea of having an accurate gauge so you know what you're good at and what you need to improve on. The second reason why it's important to separate your business finances from your personal finances and to create a separate legal business entity, is that the IRS essentially enables you to deduct from your income certain business expenses like travel or supplies or whatever it may be. We're going to go over an example of this on the next page after this slide. But just keep in mind right now, by separating your financials, that you're actually able to get tax deductions on your IRS income tax returns. The third reason is it improves access to capital. So one of the things right now, I currently work for a lender, and one of the basic essential items that we ask for is general financial statements, recent financial statements such as the balance sheet, profit and loss statement, in certain situations, cash flow projections. So I think it's really important that if you want to potentially be able to access future capital, whether it's asking for somebody to invest in your business, or applying for PPP or different disaster loans, as well as just loans with various institutions around the country, that one of the important things is that you're able to build up a business credit profile and build up business financials in order for people to access them. And then the final reason why it's important to actually separate your business financials from your personal financials is in order to limit your liability for debt. So one of the things you'll hear is that as a business owner, you want to create a separate legal entity. So that's where you'll hear things like Apple Corporation, or a small business might be known as, let's say, Trinkets LLC. So what this does is it creates a separate legal entity that is separate from you personally as a business owner, which makes it much more unlikely that a creditor or potential minor lawsuit would be able to go after your personal assets. In essence, creating a separate business entity is creating a shield of protection that shields different creditors from going after your personal assets. So if you're combining your personal and business assets, a creditor would have a much better case to go after some of your personal assets. And obviously, they look at how commingled the personal assets are with the business assets. And one of the things that they look at is actually having separate business financials from your personal financials. So just to talk about the business-related expenses for tax purposes, I just want to show you a quick example on this next page right here. And I'm going to go back into the full view mode. Give me one sec. So in this case, we have two identical examples. In my data table on the left right here, you'll see an example of somebody or a business owner who does not have their business financials and their personal financials separated. And then on the right here, you'll see the opposite situation, the situation with the same revenues and expenses, except somebody's business and personal financials are actually separated. So let's say in this case, this example, I'm going to say this is a catering company. And just to make things easier, I'm going to go with small numbers just to illustrate this a little bit better. So on the left right here, you'll see that this catering company makes $100, and while servicing their customers, they spend $60 on gas. Let's say they went to 3 different sites to make revenue, and they spend over $60 on different expenses, supplies, gas, things of that nature. Now, if their business and personal financials are not separated, they can't use this $60 business expense as a deduction. And for that reason, the taxable income is still $100 right here. So let's say they had a 20% tax rate. That means we'll tax 20%, or the IRS will tax 20% of the $100, and the tax will be $20. So they had a revenue of $100, take away $60 for travel expense, and then take away $20 of tax, and they're left with a take-home income at the end of the day of $20. But let's look at the same exact situation, except now on the right, their business and personal financials and assets are separated. So in this case, $100 of revenue, they have the same $60 travel expense, but because they included this travel expense as a business-related expense, that comes out of their taxable income. So instead of having $100 in taxable income, we now have $40 in taxable income, right? We take $100, and because the 60 is a business-related expense, that leaves us with taxable income of $40. So because the taxable income is smaller, that means the same tax rate of 20%, 20% of 40 only leaves us with $8. So at the end of the day, they started with 100, they took away $60 for travel expense, and then only $8 for tax in this situation, as opposed to $20 in this situation. So at the end of the day, they're able to take home $30 as opposed to $20, simply because they're able to separate their business financials from their personal financials and essentially create a business deduction in the form of this travel expense. So this is just a quick, small example just to show you one of the reasons that creating these separate financials and separating these financials gives you a tax break in these different situations. All right, so next I want to jump into, I know we talked about just now the importance of separating and tracking a business entity and business financials from the person who may be the 100% owner. And I want to talk a little bit about how we actually go about separating the person from the business. So the first thing that you want to do, we talked in the last couple slides ago about how it's important to create an LLC or an LLP or a corporation to create that separate legal business entity that is separate for you. So one of the main things you do, I know most of the people on this call are probably operating in Louisiana. So generally what you want to do is go on the Louisiana Secretary of State, and I posted a link right here. And there's essentially a bunch of steps you can do in order to file what's called articles of organization or articles of incorporation, which will let you register as a legal business entity within the state of Louisiana. So this is just a case right here of the different things that you can go through in order to get set up and create a business entity that is separate from yourself and obviously limits the liabilities of the business to the business assets that we talked about earlier. One of the second things I would go about doing, so the first step being creating that separate entity. The second thing would be opening a business checking account. So I think a lot of people, when they first start businesses, essentially run everything out of their personal checking account. So I know that's common at the beginning, but one of the things I would encourage people to do is look into opening a business checking account. For one, it makes it so much easier to separate your business from your personal financials. So a few things I would look at, I posted a link here to the Small Business Administration's tips when you're looking at actually opening and creating a business checking account. Thing I would look into doing is shopping around and considering different variables like the discount rate, transaction fees, different introductory offers that different banks may be offering. And then also it makes it much easier just to create those different financials that are automatically separated, because let's say you have a personal credit card and you have a business credit card. By using that business credit card just for those business expenses, it makes it much easier to track your finances and separate your finances from your personal and your business. And then the third thing, once you have that set up, would be to build some sort of accounting system. So I know, especially starting out, especially if you don't have enough revenue to justify it, for a lot of people, it doesn't really make sense. It's too expensive to hire a bookkeeper, hire an accountant, pay a bunch of money for that. So I did want to point out a few cheaper options that are much more feasible, especially if you're starting out as a business or if you don't have enough revenue where it makes sense to pay a decent amount of money for a bookkeeper. So there's a few different options. Excuse me. The first one I want to talk about really quickly. I'm not too accustomed with it, but there are several different basic free options and applications you could use to create accounting systems and sort of track your business finances. One is Wave. So here's the link right here. I'm not going to go through it right now, but I will leave that link at the end of the presentation. Another thing that a lot of people use is either Microsoft Excel or Google Sheets. And if you do happen to know what Microsoft Excel is, Google Sheets is essentially like a free version of Microsoft Excel that you get just by having a Gmail account. So I want to pull something up really quickly. Google Sheets. If you have a Gmail account, you could just go in to Google Sheets. Let me pull this up really quickly. Go to Google Sheets, and it lets you create several different types of databases or Excel spreadsheets, essentially. And then one of the really cool things about Google Sheets is you could literally just Google. I actually did this 2 days ago. So I went on Google, typed in Google Sheets profit and loss template. Made a little mistake there. So I typed in Google Sheets profit and loss template. And what made it super easy, if you don't know a whole lot about financials yet, is a lot of general templates are already created for you online. So if I'm like, hey, I don't really know how to make a profit and loss statement, I would go to a template, and this template's already been created for me. So it lets me just fill out my business name, different information, the period of time it's covering, and the different types of income, the different types of expenses that would be taken away. At the end of the day, how much profit or loss you're left with. So at the end of the day, if you don't know a ton yet about financials, this makes it really easy because all you have to do is input your own information. If you're looking through your bank statements, you figure out how much income is coming in per month. You figure out the different expenses that you may have. So that's one option that I know a lot of people like to use. Another super popular option, I think most people have heard of it if you've been in business for a little while, is QuickBooks. So QuickBooks is an accounting system. It hooks up to your bank account to make accounting much easier. It has like 4 or 5, 6 different options that you could use. But if you want to use one of the 3 like basic comprehensive packages, I think it's a lot cheaper, obviously, than hiring a bookkeeper or whatever it may be. And these tend to run like $10 to $40 a month. So that's one option you can use. And just to show you a quick run. So one cool thing that QuickBooks has, if you don't want to buy it yet, or if you just want to look into it, QuickBooks right here has this sort of test account. So I'm going to pull it up right now. So QuickBooks offers, give me one sec. So QuickBooks offers this test account, which is a test account of a fictional company. You're free to go in and use it. And this essentially lets you know what it would look like if you were to buy a QuickBooks account. So you don't have to pay for this. This is a free thing. Craig's Design and Landscaping Services is this made up fictional business. And this is just something that gives you an idea of what QuickBooks would look like if you were in fact to use QuickBooks. So you can see a bunch of different things with QuickBooks, different expenses. You can see it categorizes either automatically or manually your different expenses by connecting to your bank account. So you see these different credit card expenses and which category to go under. So this would be an automobile expense of $19.99. Jobs expense, job materials expense of $42. Another cool thing that it has is it's able to put together a lot of these different financial statements. So you can put together a balance sheet. You can put together cash flow, statement of cash flows. You can put together a profit and loss statement. So just to give you an example right here, let's say I wanted to know on a cash basis, what was my P&L like from, let's say, April 1st all the way to the end of April. So if I'm doing a profit and loss statement on a cash basis, this is going to tell me my cash inflows coming into the company. So my different cash inflows, my different revenue coming in up here, as well as the different cash flows going out of the company. So you see the different cash outflows. So this company spent $75 on advertising in April. This company spent $47 on job expenses, legal fees and professional fees, $75. So this is a cool option that you can use. I also use this as a precursor just because when we're talking about cash flow projections, we're going to be doing something very similar, but we're going to be projecting what we think is going to happen in the future. So what we think the cash inflows and outflows are going to look like in May, what they're going to look like in June, what they're going to look like in July. So one of the keys to doing that is having a basic idea of what's going on in the past. So let's say you own Craig's Design and Landscaping Services. I might look at this profit and loss statement from April. I may look at it from March. I may look at it from February. And I would try to use some of that information to get a sense of what are my typical different cash inflows during a month? What are my typical different cash outflows during a month, just by looking at the information over the last few months. So you get that information from the last few months, and it helps you project the next several months when you're putting together cash flow projections. Now, I will say the past obviously doesn't always predict the future. So especially, like I said before, with the coronavirus pandemic, nobody really could have seen this full quarantine coming. So it's really important just to understand and be conservative in the sense that you don't want to just assume the best case scenario. You want to make sure that you're equipped for potential negative scenarios that could pop up. then I want to go back and let's see.
Hey, Drew, I wanted to mention there might be some questions coming in the chat. There's one right now about payroll software that I'm not sure if you want to answer now or at a different point in the presentation.
Cool. Yeah, so I see the question now. I'm not super, so that is a good question, just to read it out loud to everybody. The question was, can you speak about Gusto and Zenefritz as payroll software? So I know there's different payroll options. I believe they essentially do some sort of accounting services as well. To be perfectly honest, I don't know a whole lot about using payroll software and what that looks like. Antonio, I'm not sure if you know either, or if you have resources to help her.
I mean, I can say a little bit about Gusto because we use it at Fund 17. And personally, I personally haven't I haven't used another payroll system as someone administering payroll. So I'm limited in that way to my experience with Gusto, but I've just found Gusto to be really, really great. The main thing that is the main 2 points that I like about it is support just responds really immediately and is just really good at solving problems on the first time. And the other good part with Gusto is they take on filing tax forms for both employees and contractors. And I'll just give you an example with all of these. Well, I'll give very briefly. So with workers' comp, if you get workers' comp, they might audit you from time to time. It's kind of hard to provide the records, but Gusto makes it really easy. If you recently with the payroll protection program, Gusto was very proactive to add the option for you to be able to export basically your 1099s and other tax documents, and it automatically gave you the calculations for what you needed to put into the different lines on your application for the payroll protection program for relief funding for COVID-19. So a lot of people that don't have financial records in place or are unable to really do that, but I just logged into Gusto and got it out very quickly and sent it to our bank. So personally, I'm a huge advocate for Gusto, and I haven't used other payroll software as someone administering payroll. I do know there's a local company, I think in St. Tammany, called NetChecks that might be looking into. I love local companies generally as a rule. And then I see another one in the chat, Zenefritz, which I'm not that familiar with. Gusto, yes, that's spelled correctly, Gusto.
Cool. Awesome. Sounds good. And then one of the other things I want to talk about, so we talked about going through QuickBooks and using some of that information to help you put together your future cash flow projections. Let's say in a different scenario, you don't want to pay for QuickBooks, you're using Microsoft Excel or Google Sheets. One of the things that you could use, although it's not perfect because the bank statement doesn't have certain one-time expenses or certain accruals, one of the things you can do is look at some of your previous bank statements. So looking at your February, looking at your March, looking at your April bank statements to start getting a sense of what your typical cash inflows and outflows are, and use that to predict what it's going to be like in the month of May, in the month of June, in the month of July, etc. So I just wanted to run through a quick example. I know this may be a little bit hard to see. So let me just run through this really quick. All right, so let's say in this example, this is a sample of a bank statement of a fictional business. Let's just say, although the dates are wrong on this, let's just pretend that this is for the month of February in 2020. Now, although the bank statement doesn't always have every single revenue and expense, it can give us a sense of what our typical cash inflows and outflows look like over the course of any given month. So let's say I'm looking at this bank statement right now. and I want to figure out what are my cash inflows? What is the typical cash coming into my business? So let's look in this case for this fictional business, main revenue. I see this deposit of $695 coming in, and I see a similar payroll deposit coming in for $695 again right here. So during the month of February, let's say $695 plus $695. So far, we have cash inflows of almost $1,400. There's another cash inflow deposit right here of $3. I'm going to ignore this for now just because I'm not sure exactly what it is and I don't want to get too into the weeds. And then we see another deposit right here, which is essentially $50 coming in from their savings account. So this is probably a business owner who transferred $50 from their personal account, potentially into their business account. So I just pull this in right here. This is another cash inflow, or in other words, cash coming into the business for $50. And then you'll see during the month of February, we're saying there's $1,440 coming into the business. And I'm going to look through withdrawals, the different cash outflows that are going out of the business. In this case, I don't know exactly what this fictional business does, but let's just say web bill payments. I pay all my web bill payments that are paid either via MasterCard or Amex are the amount I pay to my suppliers. So the amount I pay for raw materials to create whatever it is that I'm creating. So I see there's a web bill payment with MasterCard of $200. There's another web bill payment with Amex right here of $300. So let's say $200 plus $300. And I know during the month of February, there are $500 going out of my business in the amount that I'm paying to suppliers. And a few different other withdrawals let's look at. So ATM withdrawal, this is just money that a business is taking out in order to be using this just as just to have cash on hand. So I'm not going to count this as a true cash outflow. I'm going to skip some of these smaller ones for now. And then I'm going to look at electronics. So let's say there's $3 going out for electronics. There's also a telephone expense somewhere right here in telephone. So we have $7 going out and we have $3 going out. So that's a small cash outflow. Let's just say $3 plus $7. So over the course of February, there's $10 going out for electronics and telephone. Let's say the supermarket withdrawal, this amount that's going out, applies to cash going out just because the company needed to have some groceries, some food for the different employees to eat over the course of the day. So I see right here, supermarket, there's that cash outflow of $29. Few other ones I want to point out. Generally, you would go through this whole thing, but I don't want to spend too much time on it. There's an insurance one right here. That's $34. Miscellaneous, let's say, I don't know exactly what this check was for. That's $100. And then mortgage payment of $710. So you could see during the month of February, according to my bank statement, it's possible that it didn't include every single cash inflow and cash outflow. But assuming it does, there was $1,440 going into my business during the month of February, and there was almost $1,400 going out of my business for the month of February. So if you're trying to put together cash flow projections, one of the big tools I would use is to get a sense of what are my typical inflows and outflows during the course of each month. So I look at February, I would look at March, I would look at April, and then start to figure a pattern. What is the typical amount I pay to a supplier? What is the typical amount I pay for electronics? What's a typical amount I may pay for a mortgage payment? So that's how you get some of the information in order to actually put together the cash flow projections, which we're going to talk about now on this next page. So really quickly, what is a cash flow projection? So a cash flow projection shows the expected amounts of money that will come into a business along with what will go out as expenses. So before I talk a little bit more, we are going to be using the cash flow template that Teresa Kenny talked about last week that she used. So Teresa Kenny from Office Ops did a cash flow presentation last week. She did a really great job, went into very deep details explaining how to put it together, as well as using cash flow projections to make better business decisions. So we're going to talk about this on the next page, but essentially cash flow projections, you're trying to predict future cash inflows and cash outflows. Each month starts with your beginning cash balance. So let's say I'm starting May 1st I may start with $2,000 at the beginning of the month. Then I'm trying to predict how much cash is going to be coming into my business, or in other words, how much cash revenue I'm going to be making. Then I'm going to subtract the cash outflows, in other words, the expenses, the amount that's going out of my business, and that leaves me with the ending cash balance that I'm projecting that I'm going to have at the end of that month. And then we'll talk about it next, but that flows into the next month, which flows into the next month, and so on and so on. So why are cash flow projections important? There's a few reasons. One, cash is the lifeblood of most small businesses. One of the reasons a lot of small businesses fail is simply not having enough cash. So it is okay for the short term in certain situations to be generating negative cash flow, which is the cash inflows minus the cash outflows. But in general, in order to be a going concern and to be in business for a long time, over the long haul, you want to be generating a positive cash flow. So one of the things that it does is let you know what your typical cash flow is, as well as let you identify potential cash shortfalls. So I know this is super important right now during the pandemic. Figuring out, hey, in July, I may be short on cash and I need to figure something out a little bit beforehand. We already talked about the second point a little bit. So the third point is ensuring that suppliers and employees can be paid on time. So let's say, for example, I put together my cash flow projections and I'm like, wait, in July, I think I'm going to be short and not have enough cash to pay my suppliers or to pay my landlord or to pay my employees. I think one of the really important things is to be able to get ahead of it and say, and I know Teresa talked about this last week, like say maybe talk to your landlord and say, hey, it's May right now, but I think I'm going to be having difficulties on cash flow by the time August rolls around. Would be able to work out some sort of a plan where I could pay you, where I could not pay you rent in August and then pay you the rest of that rent in September, October, when I project that my cash flow is going to get much better. Obviously, this is much easier to do a few months in advance than, let's say, August rolls around and you're like, and you tell your landlord then that you're not able to pay rent, or you tell employees then that you're short on cash. I just think it's really important, not just for your own bottom line, but also as being a compassionate business owner, that you're able to figure out far in advance what some of your obstacles may be. So being able to talk to your employees and let them know 2 or 3 months in advance as opposed to the day before, that you know that there may be a potential cash issue 2 or 3 months down the road. And I think this just goes hand in hand with being a good business owner, as well as just being a compassionate business owner, and helping the stakeholders that you have within your business. And then the last thing is sort of along the lines that we just talked about, is figuring out different courses of action if you're projecting that you might have different potential cash shortfalls. All right, so I want to jump in. Again, I'm not going to spend too long in this, but I want to show you a sample cash flow projection. And again, I'm using the template. Shout out to Teresa Kenny. She did a presentation last week from Office Ops. So I just wanted to run through this, do a high-level overview. She did a great job. I believe it was Thursday of last week, going through some of these things right here. So this is a sample cash flow projection. In this case, I created a fake company. Let's say it's Yummy Foods. It's a dine-in restaurant. The business model is price per unit sold. So in other words, like a typical restaurant, you go in, you eat, you pay. There's no situation where after the restaurant delivers the food that they deliver you an invoice and you say you're going to pay in 30 or 60 days. It's just payment right there before you leave. Date updated. So I know today's May 7th, but in this example, let's say the date updated. The date I'm putting this together is April 1st, 2020. All right, so let's jump into the next page. So this is a general overview of the typical cash flow projections that you may put together. So you notice if it was April 1st, in this case, we're projecting our cash flows over April, May, June, July, August, September, October, November, so 8 months. There's really no one standard procedure. Sometimes you'll see people doing weekly cash flow projections. Sometimes you'll see them doing monthly cash flow projections. Sometimes you'll see it for 12 weeks, 13 weeks. Sometimes you'll see it, like in this case, you're projecting your cash flows for the next 8 months. So what exactly goes into cash flow projections? So in this case, this is saying the beginning balance. We're putting this together on April 1st. So my beginning cash balance on April 1st is $4,000. And in this case, we said Yummy Foods is a restaurant business, so I'm projecting that no money is going to be coming into the business due to the quarantine. So I'm going to have $0 of cash coming into my business during the month of April. For various expenses, I'm going to have $2,900 going out of the business. And then I'm going to be left with, at the end of the month, according to this projection, $1,100. So if I started with $4,000, I added $0 and I subtracted $2,900. I'm left with that $1,100 amount. And you'll see this ending cash balance, so how much we end with at the end of April, is exactly the number that we're going to start with at the beginning of May. The amount that we're projecting at the end of the May is how much we're projecting that we're going to start with at the beginning of June. So you'll see that the ending cash balance of the month correlates exactly to the beginning cash balance of the next month. One other small thing you'll notice before we go into the next part is that the net cash for the period is how much cash flow you generated, either positive or negative, during that period. So in this case, June, I'm saying $7,500 is coming in, $2,900 is going out, which leaves me with net cash for the period of $4,600. All right, let's jump to what this looks like. So this is an overview. The next tab we're going to be going through is an example of cash in, this tab right here, the cash in for each month. So looking at the cash in for each month, let's say I'm looking at April. Again, I'm using Teresa's template. So there's various different types of revenue that you could have within your company depending on your business model. So let's say just in this case, there's different types of established revenue you could potentially have, projected revenue, and then cash inflows that aren't revenue exactly, but they're cash inflows because they're money coming into your business. So an example would be if you got a PPP, which is the Paycheck Protection Program loan, you would have money coming in during that month. If you had the EIDL loan, you would have money coming in. If you decided to move some money from your personal account into your business account, again, that would be money coming into your business. So in this example right here, I'm projecting $0 is coming in during the month of April, simply due to the quarantine. Same thing with May, no money here. June, I'm not having any revenue in the sense that my business is open. However, in this case, I'm projecting that I'm going to be awarded $2,500 via the PPP, the Paycheck Protection Program, as well as $5,000 via the EIDL Disaster Relief Program. So in this case, I'm projecting $2,500 plus $5,000, which leaves me with $7,500 coming into the business that I'm projecting during the month of June. Same thing with July. There's no financing activity money coming in, but in this case, I'm projecting that in this projection that I have, that let's say the quarantine would be over in July, so I'm projecting cash inflows via customers coming in and me being able to open my restaurant again of $3,000 coming in during the month of July. So that's the cash inflow tab. And then you're left with the cash outflow tab. So that's this part right here, the cash that is going outside of your business. All right, so let's go to the cash outflow tab, see what that looks like. So again, starting with the month of April, I'm trying to figure out and project what are my typical cash outflows that I expect that are going to happen. So in this case, restaurant's going to be closed, so I'm not going to be paying any money for materials or raw ingredients, simply because in this case, I don't expect to be selling anything during April, during May, during June. Let's say in this case, I'm still planning to pay my employees. I don't want to go into the specifics of the PPP, but in a lot of situations, essentially the PPP is related to you still paying your employees. So in this case, I have $1,000 going out that I'm projecting to pay to hourly employees. A few other expenses you'll see. I know I'm going to be projected to pay $1,000 in rent, let's say, $200 in health insurance, a few other cash outflows. Let's say I'm projecting in this case $200 going out for utilities, and a few other different types of expenses. One thing I will point out, I don't have any one-time expenses, but one-time expenses are different things that you're paying very rarely or not in your typical month. This might be equipment that you need for your business, startup cost to reopen, maybe debt that you're paying down on some loan, Maybe you had a large amount that you owe to suppliers that you're going to pay most of it down. And then the last thing that you're left with right here is the other activities, financing and equity. So this is cash that's maybe going out of your business because you're paying down different lines of credit, maybe your credit card. In this case, I have one cash outflow. It's $500 for an owner's draw. So this is essentially saying is that every month I'm taking $500 out of the business. This is the salary that I'm paying myself in this case. So these are the different types of cash outflows. You'll notice when we add all the cash outflows up, this 1,000 plus 1,000 plus 200 plus 200 plus 500, we're left with $2,000 or $2,900 going out of my business during the month of April. And you'll see the next several months will look very similar. The only difference is my cash out of the business starts going up in July. Because remember, this is when we're projecting for the restaurant to open back up. So we're going to be making, we're going to be selling food. So in this situation, we would be paying people in order to buy the ingredients in order to make and sell the food. So I go back to my monthly cash flow. I see the beginning cash balance. I see the cash out, the net cash for the period, as well as the ending cash balance. Now, one quick issue you'll notice is that my cash is positive in every single month except for the month of May. So this is something, this is one of the main reasons we put together cash flow projections is we can identify potential issues well in advance before they arise. So I'm looking this right now and I want to figure out if I'm starting with $1,100 and I'm ending with negative $1,800, I got to find a way to make this positive or at least close to positive because obviously a lot of banks won't accept you having this negative amount within your bank account. So I'm going to build on what Teresa talked about last week, and I'm going to look at different options. So one possible option that you might use is, let's say you talk to your landlord and he says, all right, like, or you tell him, hey, I'm going to be short on cash during the month of May. Is it possible to just pay you twice in June instead? So in this case, I would say $0 here, and I'd be paying $2,000 here. As Teresa pointed out last week, I would just insert a note so that when you come back to this, you know, what is the reason why $0 in rent I'm projecting to be paid in May. So you just say agreement or whatever it may be with the landlord. Let's say in this example, you decided I need my cash to be positive at the end of May. So in this case, I'm not going to take an owner's draw out. So that's $0. And let's say you talk to your employees well in advance and you don't want to furlough anybody, but you need to cut back hours to $500 during the month of May to make this work. Now, based on these notes that I just did, or based on these small changes, I see the different changes that I make. I go back to my monthly cash flow, and instead of having negative $1,800, I'm left with positive $200 at the end of May. Cool. And then one last thing that I want to go through. Let me go back to my PowerPoint really quickly. Last thing I want to talk about really quickly is using these cash flow projections, not just to make those decisions about how I can get my cash flow positive, but also about deciding whether or not you want to take on a new business segment. So in this restaurant example, let's say we are deciding to whether or not we should add a takeout business in order to serve people during this quarantine, during this coronavirus pandemic. So in order to do so, we would do the same thing with cash flow projections, except we would just be figuring out the cash inflows and outflows of the new business segment. So I wouldn't be worried about what we already are planning in terms of the cash inflows and outflows. I would just be worried about what are the cash inflows and outflows created solely by adding a takeout business. So in this case, you would only add, like I said, the additional inflows and outflows created. So for example, my rent, I would not add as a cash outflow because no matter what, whether or not I decide to add this takeout business or not, I would not be paying, or I would still be paying that rent. So it's not an additional outflow being created by me adding the takeout business. One thing that I'll talk about really quickly as well is don't forget to include how the business segment that you already have, how your current business segment would how the new business segment would affect your current business segment. So the idea would be that it's possible once everything's opened up that if you still do takeout in let's say July, August, September, that some of those people, that would normally have decided to dine in your restaurant do takeout instead. So it's also important to figure out how that new business segment is going to eat at some of your current business segment sales. And then the last thing that we're looking at from a cash flow projection standpoint is any new project that's ultimately going to generate a sum of positive cash flow in the future is going to be worth it. Any new project that doesn't is ultimately not going to be worth it. So this is a slightly simplified version of what's called the net present value. But the idea is that in general, if it's going to create a lot of positive cash flow for your company, then it's worth it because it's going to be profitable. If it's not going to be profitable. So the last thing I want to run through for 5 minutes before I end up is this last slide right here. So this is me deciding whether or not it's going to be worth it, whether or not it's going to be profitable for my restaurant to do takeout during the months of April, May, June, July, whatever it may be. So I combined the cash in and the cash out on this new page. So you see the new cash inflow that would be generated from the takeout, as well as the different cash outflows down here that would be added just from doing takeout. So in this case, let's say if I do takeout during the month of April, I'm predicting that I'd be doing $3,000 in sales during the month of April. So that's $3,000 in cash coming in. Then I know I'm going to have to buy ingredients if I do this takeout structure to my business. So I'm projecting that, let's say I'm going to be paying $800 to my different suppliers in order to get the raw materials and ingredients to actually create the food for the takeout business. So that's $800 going out. I may have to hire an additional employee, whatever it may be, $500. Again, these numbers are very simple. I know employees obviously would be paid a lot more, but I just want to make these numbers simple just for this case. Again, rent, you wouldn't be paying any extra rent, right? This is not an additional cash outflow created by doing takeout. So whether or not you're doing the takeout business, you'd still be paying the same amount in rent. This probably goes the same for different things like travel, office computer supplies, etc. Another cash outflow I added is advertising and printing. Let's say a lot of people don't know that my typical restaurant is now doing takeout. So in this case, I'm adding $300 in cash outflow, as well as $400 as a startup cost just to get the word out that, hey, my restaurant is now doing takeout. Then I'm going to look at all this. So if I have cash inflow of $3,000 coming in, and then I have cash outflow of $800 plus $500 plus $300 plus $400, and that means the net cash that I would be generating from that business or from adding takeout would be $1,000. And I'm doing the same things through May, through June, July. And you could see by adding all these up, I'm getting $1,000 here. I'm getting $1,400, I think, the next month, so on and so on. So you can see that all these numbers, I'm generating a positive cash flow. So I'm generating probably between these three around 4,000, then another 1,000 or so. So let's say this whole project, if I were to add this takeout business, it would ultimately make my business $5,000 more. So this is a good decision. Now, if all these numbers were negative and it added up to a negative number, then it would simply be a bad decision. So this is just one of these other ways that we could use this cash flow projection to start making better decisions on our business. Cool. So that's, give me one sec. So that's it on my end. Again, everybody, I appreciate you joining this presentation. We're going to give it a couple minutes in case anybody has any questions. I know I saw one question in the chat box that I'm going to take a look at in a minute. If you don't have any questions right now, feel free to email me right here at drewjr28@gmail.com. So I do have time on my hands. I'm willing to offer free financial services for any small business owner that has any questions. You want to just shoot me an email, get on a 5 or 10 minute phone call. I'd be more than happy to help. And then before I look at the rest of the questions as well, here's just a link to the different things that I went through during this presentation. So let me take a look at the questions.
Hey Drew, there's not, the one question that came up was, is there going to be a replay, which for the rest of y'all who weren't watching the chat, Fund 17, well, SCORE is recording this, and Fund 17 is going to retain this and share it on social media so that will be available. We are going to post it we post on all three platforms, on Twitter, Instagram, and Facebook. So look for Fun 17 on one of those platforms. But I actually did have a question with this particular slide. Because we can't actually see the links behind some of those. Is there a way that this could...
Yeah, so I hyperlinked it, so all you have to do is click on the link right there. I could also give you this if that would be easier. I don't know how you're going to be posting the link, so just let me know, I guess, after the call, or let us know now, I guess, what would be the best option.
Okay, I'm fairly sure I can just send it. Well, I could send it through our Eventbrite RSVPs, so as well as everyone who registered on the Zoom.
Cool. Yeah, just let me know, and then we'll make it work.
Okay. All right. Well, this is your chance. If you have any questions about cash flow analysis right now, or if you came to this webinar wanting some particular information that maybe you're not feeling like you got it yet, this is the time to share your question.
Something pops up later, or feel comfortable right now, you'd also email me at drewjr28@gmail.com. But yeah, I guess we can give it another minute or so in case any questions. Maybe
just to waste time while people are hesitating to express themselves. If anyone on the call isn't aware, Fund 17 has been compiling a resource directory focused around COVID-19. I know a lot of folks have been doing this. I have gotten a lot of good feedback about our resource directory, and I would recommend that you look there. There are a lot of grant opportunities that are coming out for businesses. At the same time, the deadlines are also passing really fast, so it's hard to stay on top of them. But we do have, I believe there's still the Red Backpack Fund right now is doing 5,000 grants for women entrepreneurs. I believe Business for All is still doing grants up to 10,000. And then I think there are some local opportunities as well. There's one for anyone who is a quote unquote like artist of any medium. There's a New Orleans based program. I'm trying to find the name of it. Right now I'm looking through our directory. I'm not seeing it right now, but I put the link in the chat. So check it out if you haven't seen it. There's some information here as well on the relief funding programs that were referenced earlier. Cool. Well, I'm not seeing any further questions. Let's see. Jay, if you're listening, thank you for co-hosting this with us with SCORE. Would you have anything you might? Oh, I see someone raising their hand, I think. I'm not seeing it anymore. Jay, did you have anything you wanted to share before we get off? Oh, I think it was an accident, the person that raised their hand.
Oh, okay. No, I want to say that, Drew, thank you for sharing that information with us. That was some great information that I think was definitely needed right now in this time. And I was just happy to help where I can.
No, we appreciate it. Thanks so much.
Awesome. Well, I hope this has been a valuable session for everyone. I mentioned at the very beginning, if you would like to stay on top of the upcoming webinars that we have around COVID-19 and adapting your business, you can go to fund17.eventbrite.com. That's where we keep all of our events. I guess I'll type it, but it's fund17 www.eventbrite.com. So thank you so much, everyone, and thank you, Drew. This has been a really great webinar. Yeah, so I wish everyone luck, and I guess that's all I have to say. I wish everyone luck. Thank you for being on the webinar.
All right, sounds good. Thanks so much. Everybody have a good one.
All right, bye, Drew.
Bye.
Bye, Jay.